Hey everyone, we know you're here because you're keeping a close eye on IndusInd Bank, especially with all the recent news about their governance issues. It's got everyone thinking, right? How precarious is the situation, really? And for those of us with investments or considering them, well, that's the million-dollar question.
Absolutely. And that's exactly what we're going to untangle today, get to the bottom of it. We've got IndusInd Bank's own investor presentation, their Q3 FY25 update, some really insightful news articles that dig deeper into the story, and we're even going to look back at the Yes Bank crisis back in 2020. See if there are any parallels, any lessons we can learn. We'll break it all down, their recent financials, dive deep into those derivative losses that have everyone talking, what happened, and what it all means for the bank going forward.
Yeah, there's a lot to unpack here for
Yeah.
sure. And it's interesting because when you first glance at IndusInd Bank's investor presentation, they paint a pretty rosy picture.
They do, don't they? They're highlighting their position as the fifth largest private bank in India, talking about their diverse loan portfolio and their deposit base. And, they're showcasing some pretty impressive growth figures, too. 12% year-on-year increase in their loan book, 11% bump in deposits. That catches your eye, right?
Oh, it definitely does. And then they hit you with those capital adequacy ratios, the CRAR, sitting at a comfortable 16.46%, and their liquidity coverage ratio, the LCR, a healthy 118%. That's well above what the regulators require. On the face of it, it seems like they're in a pretty solid position.
Yeah, you see those numbers and you'd think, okay, things are pretty good. But, as investors, I think we've learned that we need to look beyond those headline figures. We need to dig a little deeper. And when we do, when we look closely at that Q3 performance for FY25, some cracks start to appear. Little things, warning signs that make you go, wait a minute.
I'm with you there. Because, yeah, they're talking about loan and deposit growth, which sounds great. But their net interest income, the NII, which is basically their bread and butter, it actually shrunk a bit. And not just year on year, but even compared to the previous quarter.
Exactly. That's not a trend you want to see.
Yeah.
And then there's the net profit. Sure, it's up a little from the last quarter, but compared to the same period last year, it's down a whopping 39%. That's a significant drop.
That is huge. And their net interest margin, the NM, that's another key indicator of profitability. It took a hit too, down 36 basis points year on year. So they're lending more, but they're making less on those loans. What's the story there?
Right. That's a key question to ask as an investor. Are they sacrificing profitability for growth? Because that can be a slippery slope. And it kind of leads us right into the main event, the elephant in the room, the governance issues, and specifically those 2,100 crore rupee derivative losses they disclosed back in March 2025.
Yeah, that really sent shockwaves through the market. And the bank, they tried to explain it away. They pointed to those RBI rule changes back in September 2023, the ones that stopped them from doing internal hedging. They said those new rules were the main culprit.
And on the surface, that might seem like a reasonable explanation. New regulations can definitely disrupt things. But here's where it gets really interesting. The news reports, they dug a little deeper, and it turns out those losses, they weren't just because of the new rules. It seems like a lot of it stemmed from how they were accounting for losses on some Forex derivatives and swap transactions. And here's the kicker. These transactions happened before April 2024, some of them going back 5, even 7 years.
So wait, they're blaming the new rules, but the losses are coming from transactions that happened before those rules even came into effect. That seems a bit off, doesn't it?
It does, right. And the more you look into it, the more red flags pop up. It seems they weren't recognizing those losses through their net interest income. But get this, any gains they made from these same activities, they were happily reporting those in their profit and loss statement.
Okay, hold on. So they're cherry picking what they report. That's a huge problem, especially from a transparency perspective. As an investor, how are you supposed to trust their past financial reports if they're playing these kinds of games?
Exactly. It throws everything into question. Were their earnings over the past few years even accurate? And it raises some serious concerns about their internal controls. How could this go unnoticed for so long? Years. The sources we've seen, they suggest that those internal trades and the interest that accrued, they weren't being unwound daily like they should have been. So basically, they were making these internal bets on currency movements, trying to offset risks. But when those rules changed, they couldn't do that internal netting anymore. And suddenly, boom, years of losses they hadn't properly accounted for. They're staring them in the face.
I mean, it's almost like they were sweeping things under the rug, hoping no one would notice. And the fact that it went on for so long, that a gap in their balance sheet that big could stay hidden, It's mind-boggling, especially because we know they have central recording for Forex trades. So how did this slip through the cracks?
It's a major red flag, no doubt. It really makes you wonder about their risk management, their governance structure, their whole approach to transparency. And some of those news articles, they're even speculating that the RBI might have been the one to force their hand, to make them disclose these losses.
That wouldn't be surprising, would it? I mean, how else could something this big stay hidden for so long? And it makes you think, what else are the regulators looking at? What other skeletons might be in the closet?
It's a valid concern, especially for an investor. And then you add in the timing of the CFO's departure. Gobin Jain, he left abruptly on January 17th, 2025, just weeks before these losses came to light.
Talk about suspicious timing. I mean, call me cynical, but when a key financial officer exits right before a major financial bombshell drops, it's hard not to raise an eyebrow. It makes you wonder what he knew and when he knew it.
Right. Doesn't look good, does it? And, it's not just him. We also need to consider those share sales by the CEO, Sumant Kathpalia, and the deputy CEO, Arun Khurana. They sold a pretty hefty chunk of shares, 157 crore rupees worth, in the years leading up to this.
Yeah, I saw that. It's not necessarily proof of wrongdoing, but it definitely adds another layer of intrigue to the story. Were they getting out while the getting was good? It makes you think.
It does. It raises questions about insider knowledge and whether they had doubts about the bank's future prospects. And then there's the RBI's decision regarding Kathpalia's reappointment. Remember, the board recommended a 3-year term back in September 2024, but the RBI only gave him 1 year until March 2026.
That's a pretty clear signal from the regulator, isn't it? They're not exactly expressing full confidence in the bank's leadership. And it makes you wonder, are they worried about more potential hits to capital down the line because of all these hidden issues?
It's a valid point. The RBI, they understand the importance of public confidence in the banking system. They can't afford to have people panicking, pulling their money out of banks. That's why they issued that statement, trying to reassure depositors.
Right. They emphasize that the bank's financial health is still stable, that they're keeping a close eye on things. They pointed to the deposit growth, the decent CRAR, the provision coverage ratio, all that. They even highlighted the LCR, which was still healthy in early March. They're trying to project calm, prevent a bank run.
Exactly. They're trying to manage the situation, which is understandable. But as investors, we have to be a bit more critical. We have to weigh those reassurances against the hard facts. And that's where comparing this situation to Yes Bank back in 2020 can be really helpful.
Yeah, that was a whole different level of crisis, wasn't it? Yes
Yeah.
Bank was on the verge of collapse. In early 2020, they reported a massive quarterly loss, 185 billion rupees, and their CET1 ratio, that key part of the CRAR, it had plummeted to a scary 0.6%. That's basically on life support.
Right. And all of that was driven by a mountain of bad loans, those non-performing assets, and some really risky bets they had made in certain sectors.
And the actions the RBI had to take were drastic. They imposed a moratorium, replaced the entire board, and then SBI had to come in and inject a huge amount of capital, 100 billion rupees, just to keep Yes Bank afloat.
And that's the contrast. IndusInd, they're definitely dealing with some serious governance issues, no question.
Yeah.
But their financial position right now, at least on paper, doesn't seem to be as dire as Yes Bank's was back then. Their CRAR is still over 16%. And the RBI, even though they're clearly keeping a close watch, they're still publicly saying that IndusInd's financial position is satisfactory.
Okay, so it's not a Yes Bank situation, not yet anyway, but it's still a pretty big mess. And their strategy for dealing with it, it's interesting. They've raised $2 billion through what they call bulk deposits.
Yeah, I noticed that too. It's a different approach compared to Yes Bank. They're not getting a bailout or a major restructuring. They're going out and getting these bulk deposits, which are probably costing them a bit more in interest.
It suggests they're still able to access funding, but it might be putting pressure on their margins going forward. And it also makes you wonder, are they having trouble attracting those cheaper Kasai deposits? Because if they were, they might need to rely on these pricier bulk deposits just to keep the lights on.
That's a good point. It's something to keep an eye on. And, even though the bank is trying to project an image of strength in their investor presentation, there are some subtle hints that things might not be as perfect as they'd like us to believe.
Like what? What are you seeing?
Well, for one, their asset quality. It's deteriorated slightly. Their gross and net NPAs, they've both ticked up a bit compared to previous periods. Not a huge jump, but still a sign that things might be moving in the wrong direction.
And then there's that declining net interest margin we talked about earlier. Again, not a massive drop, but it's something to watch. It suggests their core lending business might not be as profitable as it once was.
These are the details, the nuances that investors need to pay close attention to. It's not just about the big headlines. It's about digging into the fine print, connecting the dots, and forming your own assessment.
Absolutely. Because at the end of the day, as investors, we're the ones who bear the risk. So we need to ask the tough questions. How deep do these accounting problems go? What other surprises might be lurking beneath the surface? And how will all of this impact the bank's future performance, its profitability, and ultimately its stock price?
Right. And then there's the question of investor confidence. How will this whole episode affect how people view the bank? Will they be hesitant to invest? Will they pull their money out? These are all valid concerns.
So let's try to sum all this up for our listeners who are trying to make sense of the IndusInd Bank situation. The bank is definitely facing some strong headwinds right now. They've got these governance issues, the undisclosed derivative losses, the accounting practices that raise serious questions about their transparency.
And while the RBI is saying they're stable and the bank is highlighting their strengths, those recent events, the CFO leaving, the share sales by top execs, the RBI's short leash on the CEO, it all points to some potentially serious weaknesses in their risk management and their internal controls.
We've seen this before. It might not be a yes bank situation yet, but it's a reminder that even seemingly strong banks can have hidden vulnerabilities, and those vulnerabilities can have a real impact on their future performance and investor confidence.
So the key question for you, the investor, is this. How do you weigh the bank's reported strengths against these very real governance concerns? What additional information do you need to make a truly informed decision?
We always say knowledge is power, and in the world of investing, that's truer than ever. So dig deeper, ask those tough questions, and do your own due diligence. And hopefully, this deep dive has given you a solid foundation to start building on.